Be the change you want to see. Make a difference by giving your money a purpose, a mission to do good. Welcome to Money with Mission, where we talk to individuals, businesses, and organizations who are taking the lead and whose actions are impacting the well-being of their communities and the world at large.
Everybody, welcome back to Money with Mission. Today I have Kevin Palka. Kevin is from MVP Equities in Virginia. Kevin has loved real estate since he was a young man. His drive and motivation have only grown over the 20 years that he's been investing in it across the Mid-Atlantic region of the United States. He has had much success and is proud to say that his track record has yielded steady and constant returns for his investors. As his investment opportunities and deal flow became more constant, he founded MVP Equities, which he named after his son. MVP Equities allows friends and families to invest alongside Kevin. MVP Equities is changing people's lives in multifamily real estate by creating wealth across a vast demographic of individuals and companies. MVP Equities has emerged as an equity firm with cutting-edge approaches to multifamily investments and wealth creation that provides certainty. Something we could all use a lot more of is certainty. Welcome, Kevin. Thanks so much for coming on.
Thanks for having me, Felicia. I appreciate it.
Yeah, so I'm excited to learn more. When we first had our conversation, MVP, most valuable player, that was my first thing. And so when you told me it was named after your son, I think I had to ask you your son's name. We might as well go ahead and clear that up for everybody right now.
Yeah, so the quick story is our first child died at birth, and we named him Mason Victor Palka. So it's in honor of him. My wife and I felt that was just a proper thing to do, and it was very near and dear to our heart, obviously. So Mason Victor is MVP Equities.
That's
and,
your
his
company.
spirit lives on.
He's here with you. That's amazing. You did not tell me that, so thank you for sharing that. I appreciate it.
Sure.
Appreciate it. So you've been investing for the past 20 years. Did you start out doing syndications like you are now, or how did you start in your real estate career?
Yeah, the syndication part of it has gotten more frequent, I think, across the market in real estate investing in that term. Back when I first started, I moved to Washington, D.C. in 2002, Virginia, Washington, D.C. area in 2002. And back then, I moved here to take a job with a large development company building larger scale multifamily projects, like high-rise type building stuff, 1 to 2, 300 unit projects. But on the side at night, when I moved here, I didn't know anybody. So I had no friends. I didn't know anybody. So what I just kept myself busy by working. And I bought my first rental property in 2002 in Lake Ridge, Virginia. It was a small townhouse project. And that was before 2008. So you could get loans a little bit easier than you can now. And I had actually borrowed $4,000 from my grandmother. Mm-hmm. And I took that money and used it as my down payment with an FHA loan. And I did an FHA 203K loan, which is an investor rehab loan. And I was able to purchase this property, renovate it. I would go to work, and then at 5 o'clock, I'd go to the house and work till midnight and renovate it. And then the same thing on the weekends, I'd renovate it. And then within 2-3 months, I had it ready and I put it up for rent. And so I raised money from my grandmother family and was able to just get this property rented. I held it for 2 years. And the ironic thing is I actually sold it to the realtor who sold it to me.
Wow.
Yeah. And if that wasn't a statement at the time of how hot the real estate market was, I don't know what is. And from there, that was my first rental property. And I did that while I was working my career for another company. So I was gaining experience not only in my day job, but in my evening hobby of renovating houses as well.
Okay. So your day job was development. I'm not sure we got clear on that. What was your day job?
Yeah, so I was development. I was a project manager for a development company. So it wasn't my company. I was employed. That was when I was, getting my experience. I worked for a company called Diamond Properties, and they were a multifamily developer. Like I said, they did larger projects, 200-300 unit projects, high-rise condominium type stuff. And so I worked for them until 2008. And then in 2008, when the bottom dropped out, that's when I actually started my company.
Okay. Did they did they lose? Did they let you go? How did that?
Yeah, I was let go because they were not building any more projects. They were in financial distress, just like a lot of the multifamily builders at the time. Condos, people were walking away from their deposits, and therefore they weren't selling the units. And then they had to turn them to rentals. So they just basically stopped building at that time. But the funny thing was, I got picked up from another development company that I'd stayed on with for about a year as well, helped them finish a project. And at that point, I decided that they wanted me to go into single family home building, which I didn't want to do. And I decided to just start my company at that time.
So tell me about your mindset in 2008 when you lost your job with Diamond Development. You saw what was happening to them, and you knew, I mean, you can kind of look around and see the countries, and we got a problem here with real estate.
Yep.
You worked for a little bit longer with another company in project development, but what made you say, well, this isn't, what made you do your next step in starting MVP Equities?
Yeah, so I decided that, I'm either going to go all in, or if I'm going to fail, I'm going to fail hard, and I'm going to do it. I wasn't afraid to fail. No risk means no reward. So to me, I knew that the area I lived in, which is Northern Virginia, Washington, D.C. area, had strong fundamentals. We have the federal government here. There's a lot. The economy is different than other areas of the country. So I did have that going for me, and that was a huge factor. And this area rebounded rather quickly. Within 2 to 3 years, by 2011, this area was already appreciating again in real estate. So I capitalized on that trend and took a risk, in 2008 by starting my company. But we started out slow. We took baby steps. There was a huge need in Washington, D.C., in the city itself, for renovating the old historic row houses. Huge need for more quality, new multifamily neighborhoods and housing. So that trend, even though the profits weren't as good as they were before 2008, it wasn't about the profits. It was about getting the experience and building a track record. And that's where I am today stands, is because I took all of those small little baby steps. It wasn't an object, a bright shiny object where I want to go and hit this home run right off the bat. That's not how it would work. That's not a good recipe for success. So it was breaking it down into little pieces, getting the experience, small project by small project, and just building upon that every single day.
So that was really good. Thank you. The not running for the big, not going for the home run on your first hit, but still in 2008, real estate was not the place where most people were running. Was it
Right.
because that's what you knew? And it's like, well, if I'm going to do it, this is what I know. So I've got to stay here. That's one question. And then the other one is, what is your makeup or have you ever thought about what makes you not afraid to fail? And if you're going to fail, you're going to fail big, fast. What is that? Because
Great question. Great question. So I'll work backwards. So my father was not the best businessman. My mom actually supported us a lot more than my father did, and I saw that growing up. So when I was 12, 13 years old, I was a paper boy. By the time I was 15, I was in a vocational program building houses. So I've always just had the drive to work.
Okay.
And everything I have, I bought. I paid for my own college. I paid for my own first car, which was a 1983 Pontiac J2000, all these things that I just worked for, and I just had this natural drive. I guess I am fortunate in a way that I have this natural drive to want to work, and I want to figure things out, and I want to be successful. So my mindset is nothing is going to stop me. As cliche as that is, it's true. It's just in my fabric, and it's what creates certainty in me to realize that I'm not going to let my ego take over what direction I'm going to go in life. Like, I want to get to a certain status. That is also a recipe for failure. it's my purpose and what I really love to do, which was I always loved to build things.
Mm-hmm.
And I always had a dream of owning and building multifamily real estate. So this is something that was kind of engraved in my dreams as a kid of what I wanted to do.
Okay.
So for that, it was really just a divine purpose to want to be successful and do it in small little bits and pieces at a time.
Okay. So now talk about a failure somewhere where you failed hard and you had to get up and keep on going.
Yeah, I mean, so I had a project back in 2011 that we got delayed. We bought the property and we got delayed in our zoning approvals and permit approvals, and I ended up having to carry the property about a year longer um, than I should have, and that affected. We ended up not really making any money on it, and that was not a tough pill to swallow, but it was the reality of the situation. I think my mindset back then was a little more fragile, where because I was younger and didn't understand certain things and didn't have the track record that I do now. But it really was just like, all right, this kind of stinks, but we were able to move on from it, and we learned, certain procedures and criteria that we would look for when we buy a property, which was we wouldn't close on a contract unless it had zoning approval. Things like that, little tricks of the trade, list of lessons learned that we now implement and would never go back to again. But I always say that there's no growth without pain. You got to experience some pain to experience growth. And if you're getting a little bit of resistance and you feel a little resistance in what you're doing, that's probably telling you that you're moving in the right direction. Mm-hmm. Because you're moving towards something, you're moving towards a target. So yes, I picked myself up, and luckily we didn't lose a lot of money. We just didn't make any money, but we were able to learn from it and not make that mistake again.
That's great. We're going to go away for just a moment and be right back to hear more about the story. Money with Mission is a real estate and business investment company that specializes in finding projects that have the potential to give you a great return on your investment dollar and make an impact in the communities where we invest. Make a difference in your life and the lives of others. Go to moneywithmission.com to learn more. Okay, welcome back, guys. We're going to finish with this. I have a couple more questions with Kevin about these lessons that you learned with this deal. Did you have investors involved in that deal?
Luckily, we didn't. It was my own money, so there was nobody else because we were still very small at the time. So luckily for me, there was nobody else involved, and I didn't. The one thing I've learned, and now the difference between now and back then, is I have a lot of mentors and coaches that I work with that hold me accountable. Okay. I would say back then I wasn't as good as holding myself accountable as I am now, but that's part of that pain and growing process that got me to where I am today. And now it's a lot different because everything is about accountability. You just have to be accountable to everything you're doing, especially now when we're taking on millions and millions of dollars of investment money from other investors. It's a huge stewardship. And we have to know what we're doing, because the way I look at it, we're employing other people, we're employing other families by investing their money to help them grow legacy wealth. So it's a lot different now. It's just a huge stewardship that I take very, very seriously. And it's something I actually have grown to love, because we are helping other families and other people, get involved in real estate and make money at it and learn at the same time. And I would tell anybody that's getting into real estate, work with somebody or do a project together with somebody who's already done it. Maybe you can find a developer that you're investing in his project, mm-hmm. and you can ride along his coattails and learn. That's the one thing I would say I would do differently back, 10, 15 years ago, as I would have partnered with somebody, at least on the first couple deals, to get my feet wet and really see how the game is played.
Got it. So, okay. Lessons learned were just a lot of the smaller things, the little detaily things that you weren't paying attention to, like you said, not going under contract until zoning was in.
That's a big one, yeah.
Making sure you're capitalized enough, and all those different things that we learn when we have a failure in real estate. Got it.
Yeah.
Talk about that first time you decided to take investor money, because that, just hearing you talk about it, it's a big responsibility. And how did you decide that, okay, I can do this and I'm going to help other people along the way? Tell me how you got to that.
So this is how I got to and give the advice of working with somebody. I actually partnered with somebody on my first large syndication deal, a gentleman by the name of Dan Lesniak, who actually has done a lot of these syndications, and I was able to do the first deal with him, and we were able to, so I rode along with his coattails. I was able to see how they did it and do it the proper way, legally, the whole shebang, consultants that you need. There's a proper way to do it. So, and I'm a quick learner. It didn't take me more than, a couple months to learn it, and I was off to the races. And it was just, we have the certain syndication attorneys that we use on board that put together our offerings, certain tax specialists that help us to audit our financials to make sure that everything's transparent with our investors. There's a lot of pieces to the puzzle, but you can outsource a lot of this. So it's not as hard as people think, but you got to have the right resources in place. And what we call, you got to have the right process map, write it out on paper on who's going to do what, how it flows, an accountability chart, the whole shebang to make sure it's organized. If it's organized, it'll go very well.
That's something I had to learn along the way too, is process maps and responsibility. Who's responsible for that? And it can't be everybody's responsible for it, because nobody does it if everybody's responsible for it. Those are really, really good nuggets. So for people who want to invest in real estate, but don't want to get their hands dirty, they don't care about, figuring out how to put together a syndication. They don't care about that. Talk about how you do talk to them. Talk about how that works for you and your company and MVP Equities.
Yeah, great question. So right now we do webinars every couple of weeks where we get maybe 10 to 20 people on a webinar. And even this last project, we just funded our Richmond, Virginia project, which is 224 units. We had about 15 investors that are all actually former airline pilots, and they wanted to take their pension money and put it into something, but they got burned by doing their own housing flips.
Okay.
Everybody wants to do a housing flip. There's that huge, trend. People are watching the HGTV channel and they see all this stuff being done, but it's a lot of work. It's a lot of work even to flip one house. And, some people don't realize what's involved. So we're seeing a lot of people like that say, yes, we want to come into just a syndication. We want to give you, the experienced developer, our money. We know it's going to be in a safe place. We know it's secured by real estate. We know it's secured by real estate in a great location. And we just want to sit back and not do anything. The one thing that we have too now is we have an investor portal that, so any investor or offering that we have coming online, they can go to our website and log in and see everything in real time. They can see our offering, they can see our other projects that we've done and our track record. And, that portal is being built now and should be up soon, but we communicate with them through that portal now, and we're going to be doing that. It allows a lot more transparency. Existing investors can log in and see their investment in real time. They can print statements. So you're seeing a lot of these people, because of that transparency, that from their phone, they can invest their money, not do anything from the couch, and still look at the phone and see what's happening with their investment, what's happening with their project, just like you would your bank account.
Yeah.
And you can see it. It's interactive. There's transparency. So it's not like they give us their money and then they don't talk to us for 2 years. Every month we're sending out investor updates. I get on a one-on-one call with each investor before they actually invest money, or we do a Zoom like this, they want to see who they're investing with. So we're happy. I mean, I went last week, we had a rather large high net worth individual wanting to come into one of our projects. I flew to Chicago for the day to meet with them. And I sat there and met with their team, and then I flew back the same day. Yeah. So we do in-person meetings as well with the larger net worth investors. There's a lot of personal touch involved because they want to know who they're investing with. They're really putting their money with me. So there's got to be a conversation there. There's always got to be a conversation. And, we do probably 4 to 5 of them a day. We're talking to people, different folks, and then sharing information.
So that is key to me, is that in investing in real estate and investing how we're doing it with syndications is not the same as investing in your 401k, where you just take your money and you put it in a suitcase. This is how I picture it. I put my money in a suitcase. I hand it to somebody I've never met before and trust them to take care of it. Your due diligence with investing in real estate, if you're going to invest in a syndication, is understanding where you're putting your money, who you're giving your money to, not even necessarily the project as much as who it is. Kevin wants you to know him. I want you to know me. Before you give me your money, we're not doing a deal until we know who you are, and you know who I am, and you know who Kevin is, so that things just are much easier to do when you know who has your money and what they're doing with it.
Absolutely. That transparency is paramount. And, the beauty of real estate is, not like the 401k or stock market, which is just paper. You're investing in brick and mortar. It's an asset, and it has value. And, even on a long-term play, it just outperforms the stock market, and it's just got a lot more security.
Yep. I'm all in your camp on that one for sure. Why don't you just buy buildings that are already built and start the cash flow right away? Tell me about that. How does that?
Fantastic question. So there's a huge trend right now in multifamily real estate to buy value add properties.
Mm-hmm.
The problem is that we see is that most of the value is taken by the seller. They're advertised as value add, but a lot of the value add is being taken by the existing seller. For example, we build on new construction at a 6% cap rate. Okay. On a 10-year hold, we're going to turn around and sell that at a 4.
I'm going to have you explain that cap rate, because some of the listeners don't know what that is. Okay.
So cap rates are based on the amount of net operating income you have. Net operating income is your total amount of lease money that you get for renting the units. Divide that by your expenses and you get your net operating income. So, and then the percentages are calculated. If you Google NOI, there's actually a calculator that comes up that can explain it and tell you more about NOI. But so the beautiful thing about multifamily real estate is that, as opposed to single family houses are valued based on their comps in the area. Multifamily is based on NOI and cap rate. So if you can create more value and increase NOI, increase the value and the cap rate of your property.
Okay.
So when you're building at a higher cap rate, that means you're building for an economical price. And when you're selling low, you're getting the best value. The higher it goes, the cheaper it gets. The lower it goes, the more expensive it gets. So it's kind of the opposite. Lower cap rate means higher sale price.
Got it.
So when we're building at a 6, if you just figure them, just round math of 2%, where that 2% over a 10-year period of paying down the mortgage is huge. When we build new, we're creating the value. So on value add that you're purchasing, you're already buying it at a 4%. So that 2% you get with new construction, you're not getting.
Mm-hmm.
Even though it's already producing income, the value, like I said, is already being taken by the existing owner. So because of the demand for real estate right now, when you're purchasing existing properties, the cap rates are still very low because there's such a need for housing. So to us, we see the advantage twofold. One, there's a huge need for housing over the next 10 years. By the year 2030, there's another 40 to 60,000 housing units that need to be built in order to keep up with population growth. That's just population. Across the country. Yep. If you look at the census statistics or the National Association of Home Builders, this is all public information, because it's not, the beautiful thing about that, it's not job growth, population growth. Okay.
And how many units did you say? I apologize.
40 to 60,000 units over the next 10 years.
Over the next 10 years due to population growth.
Population growth. Correct.
Go ahead.
And so that's a huge need. So there's the gap between that right now. There's that new multifamily product that is needed. Plus, the interest rates for new construction product right now are phenomenal. And I know that when I'm building a product, I'm also designing it for millennials and people that are working from home. When you buy a value add that was built in the 80s and even 90s, you have limitations on the amount of renovation you can do. We're building products that, millennials want, people that, want to work from home want. We're giving them the types of amenities, and I know what I'm getting because I'm building the product. So to me, there's a lot more certainty. There's a lot more room for profitability, as opposed to buying an existing property. I just don't see the value right now. There are deals out there that are excellent, but they are extremely hard to find.
Got it. With the development project, as an investor, I invest my money with you. How long does it generally take for me to see any kind of return? I've been in developments before, and actually I'm in one now that's been almost 5 years and I've seen nothing. Is that what we would expect, or is it?
No, not from us.
Just so you guys know, it's unusual. There've been a lot of issues, and the syndicator is very open and transparent about the issues. There's just a lot of issues. Go ahead.
No, it does happen. It's never happened to us, but our typical investment turnaround is 24 months to 36 months.
Okay.
We offer, depending on this offering we have coming out, if you have to be an accredited investor, first of all, and we have to point that out. That's very important.
Yep.
That's the big thing. But we offer a 15% annual return on your money. So if you invest $100,000, every year you're making $15,000 on your money. So over a 2-year period on a $100,000 investment, you're going to make $30,000. The beauty of not taking a monthly dividend check, like if you buy or invest in like a Grant Cardone fund, for example, where he's paying you got to watch out for those funds because they're great funds, but they're paying you a preferred rate of about 5 to 6%. And then if the project reaches a certain level of profitability, then your return gets boosted to 12, or let's say 15. With us, it's a straight 15%. There's no hurdles to overcome. So we're offering that return, guaranteed 15% return no matter what. That's the difference between us and a lot of other funds. And that money is paid back to the investor once we build the project and we start to get the stabilization period where it's rented up. And at that point, our construction loan converts to a permanent loan and we refinance. Mm-hmm. And when we refinance, we take out the investors that put their money in, and they can go into another project and defer their taxes. If you're taking a coupon every month, like a Grant Cardone fund, you're going to pay taxes on that every year. When you continue to defer or reinvest, you're deferring your taxes. And it just depends on personal preference on what people like to do.
And what your goals are with your investing.
Correct.
So do you set up your deals where about every 2 years you're doing another one so that investor does have the opportunity to reinvest if that's what they want to do?
Yeah, so on any given year, we're doing about 2 to 3 deals, sometimes 4. So they have the ability, even when they're done with one project, to put their money right into another fund, or they can just take the original 100, roll that over, take the 30 that they made on 2 years and go, take that and, if they need it for, buy a new house or new car, they can do that too.
Okay.
And just reinvest the principal and then take out the profit. So there's different ways to do it that reduce your tax liability. And we can assist folks with that as well.
Got it. So a couple of things with the recent pandemic. I was trying to think of a different word to call it because I'm sick of calling it a pandemic. But I've seen research, I've seen studies that are showing that individuals are looking more at single family houses as opposed to the large multifamily because it feels like, more likely to get some disease if I live amongst a bunch of people. Are you seeing that in your research, or help me understand why you've decided to continue with multifamily? I think at one point you said single family wasn't your place to go.
Yeah, so the single family market is still very strong as well. The housing stock is continuously getting renovated and turned over. It's still very strong, and it probably goes. What we see is it going parallel with multifamily. we don't look down at single family housing market at all. It's just not what we do. But we see it increasing and going parallel with multifamily as far as the growth. That 40 to 60,000 units we talked about is mainly multifamily housing, but they do talk about there's a huge need for single families as well. I think it works congruently because you have a lot of population that wants to be in that single family house, but you also have a lot of empty nesters. Millennials certainly don't want to be in a single family house. Our project in Richmond, Virginia is made up of attorneys, doctors, retirees, and young students at the graduate schools nearby. So, it's a mixed demographic. I think you're going to continue to see that trend of mixed demographic. Cities like Charlotte, where there's huge job growth and population growth, millennials want to move there and rent. They don't want to buy because they're moving from the northern states and they want to see if it's for them. They want to see if they want to stay in Charlotte, or they're going to move in 2 years, or do they like their job, or do they want to move to a different neighborhood? So you're going to see a lot of moving around in that younger generation and not wanting to buy things. I still think, like my generation, I'm 45, Generation X, I guess, as we were called. Our generation is more susceptible to buying than renting. But the younger generation and the older generation, the opposite ends on each side of that spectrum, are renting.
Yes, I got it. And I like what you said about the parallel, because at some point the millennial generation is probably going to want to buy single family houses, to raise their children, to do the things that us older generation folks are doing. Got it. Makes a lot of sense to me. Another quick question here. It's a failure question. Have you ever not been able to meet your projected obligation to investors at the time you thought? And how did you guys handle that if you did?
Yeah, I mean, from time to time, we do go over the 24 months. If we sell the investor on a 24-month, right now, everything you see from us will say 24 to 36 months, just to be transparent with everybody. But we have gone over, and mostly with everybody, what we do, if we have gone over in the past, like a few months, what we do is before the pandemic, we actually had dinners for local investors, and we get everybody together and meet in person. But now what we do is we do investor updates for projects, and we'll gather the investors together at like a 7:00 on an evening during the week. We actually recently just did this where we sent everybody a DoorDash coupon. We bought dinner for everybody, and everybody was on the call eating and talking at the same time while we gave investor updates. So it's really about communication to the investor. What they're concerned about is that their investment is still safe and secure, and they're still making money. So even though they go over 24 months, they're still getting their return. So ultimately, as long as your project is not, let's say, that we're finishing, not going to get a certificate of occupancy, and then we start having problems with construction, that's when it would be a problem. But we've never had that happen. All the general contractors we work with that build our projects are Fortune 500 and Fortune 100 companies.
Yeah,
they're financially strong and they guarantee the job.
Those are all amazing and great things that Kevin said. And those are the kind of things you'll find out about the person you're about to give your money to when you have a conversation. So those are conversations you need to have so that you know exactly how they think. All these things Kevin has in place, all these things that are good, it can still happen where something falls apart. It just falls apart, just like with this deal I'm in. And the difference for us is that we are talking to investors and explaining what's going on. You're not left out in the dark watching the stock market fall and wondering what the heck's happening. You know exactly what's happening and how we are working, or how Kevin's working to resolve the issue that's slowing down you getting your money. It's very clear. That's one of the best things to me about syndication and private equity investing and investing in real estate. You can see exactly what's going on.
Exactly. It's very transparent and it's actually very safe.
Yeah, I love it. Hey, listen, you guys, Kevin has for you a free case study where you will learn how to consistently generate positive cash flow in difficult markets, an easy 3-step system for high yield real estate investing, and the number one secret of top accredited investors for generating passive income. Go to moneywithmission.com. We'll have a spot for you under resources where you can find that and get over to Kevin's site to get this free case study. Kevin, thank you so much for being on. I'm sure you'll get some people trying to connect with you. Kevin's got a deal right now, as a matter of fact. Talk a little bit about that real quick, just so we can get people interested in that too.
Yeah, we have a fantastic opportunity in Charlotte, North Carolina. We just got our zoning. We're about to get our zoning approval to build and develop 506 units in North Charlotte. It's 104 townhomes and 406 apartments. We're just launching our fund this week, which is a 506c fund to invest, where you can get a 15 to 18% return. And it's about a 3-year project for this one because it is a larger project for 506 units, but it's in a fantastic location. 15 minutes north of Charlotte and then 15 minutes south of Lake Norman. So you're right in between the city and the wilderness. So it's kind of cool. You can find it at our website at mvpequities.com and check it out, or schedule a call to find out more.
Perfect. So you guys, Kevin talks about a lot of things about how millennials are moving, and Charlotte's had high job growth and population growth. And this isn't stuff he's making up. There's lots of research that goes into figuring out where's the best place to build, and MVP Equities is doing that. Check it out. Go to moneywithmission.com, get his free case study, go to MVP Equities, check out what's going on. Accredited investors for this investment. Accredited means, you want to go ahead and spell that out so we make sure everybody knows?
Sure, yes. Accredited investors, if you have a certain net worth, you can Google it, but it's a certain net worth of at least $300,000 or $1 million in total assets in your possession.
Perfect. Okay, guys, thank you so much. And check out what Kevin's got for you. See you next time.
You've been listening to Money with Mission. There are projects happening right now where you can make a great return while positively impacting the lives of others. To learn more about today's guest or to download 7 steps to building resilient wealth for women, visit www.moneywithmission.com.
I hope you enjoyed the interview and are inspired to give your money a mission. Until next time, send your investment dollars into the world to bring you a financial return and improve the lives of others.